So, welcome back, boys and girls, ladies and germs. We are now going to recompute the investment opportunity set and we include the market portfolio, where the market portfolio will be approximated by the equal weight portfolio. All right? So we're going to adjust that picture so here the heading is 1 over n into inf op. Yeah, that's kind of what we do. Okay, great. So the first thing we do, we need the equal weight portfolio, the 1 over n rule. The way we do that in Python could be, we say 1 divided by rd dot shape 1, divide by the number of columns for I in range, rd dot shape 1. Okay, right, if you look at that, that's what it looks like. 2.38% for all stocks. All right. And let's again check in RD. There is no 1 over n in there. And now we want to add it. Okay. So how do we do it? We simply, okay, maybe for the video it might be better if I just use another cell. Okay, but I want to keep working here on that cell. RD of 1 over n, it's a pandas data frame. We're just adding the column 1 over n. And that shall be the existing RD, which are just our Euro area blue chips. And we take the dot product with the equal weight portfolio. Right? If you now plot rd.hat, see what's inside, you see we now have the 1 over n in that. Okay. So next thing we do, we have to adjust the investment opportunities. Okay. Now let me save some time and just copy paste. Yeah, it's just a notebook. It's not formal prototyping or production-based code or whatsoever. It's just teaching code. And we've been using that in other videos already. It might be too small, so I just magnify it. We're just rewriting investment opportunity. Take the RD, so it's corrected for the SAP error. It is already containing the 1 over n. Give me the mean, standard deviation, and annualize everything. Right? And then show it. That's what's going on here. So you see the market has a 5% mean and a 22% vol. So that's already a pretty low vol. All right, and then again, let me just save some time. The time is valuable. So yeah, we just do a plot where we take the inf op, which we just overwrote with all the assets, including 1 over n, and give us a scatter plot and do some annotation. Okay, right? So here's what I promised, learning point about diversification. Now, what does diversification mean? Don't put all your eggs into one basket. You've heard that. But what it means here in that graph is if you invest into a portfolio of these risky assets, your volatility shrinks. Why? Because the underlying assets do not share a correlation of 1, but a correlation of less than 1. And therefore, some of the firm-specific risks, some of the risks that only affect, let's say, BASF, yeah, that's a risk. It affects BASF and it might not affect the Telefonica. And therefore, if you put these together, some of that firm-specific risk gets diversified. One example could be if you have for Volkswagen, you have the diesel scandal, and we don't have Tesla in here, but let's assume you had Tesla in here. This negative diesel scandal shock is a positive Tesla shock, potentially. So then you would even have a slightly negative correlation in this example here, or a strongly negative. And that just reduces the amount of overall risk in your portfolio. And that's what you see here. Next learning point is the market risk is not zero. If you stay invested in the market, here we have a 1/n rule, so 2.4% roughly for every stock. You just see that the overall vol is then 22% that you have to live with if you want to be 100% in the 1/n portfolio. You also see in terms of expected return, it's just kind of what the average firm earned. But the risk is less than the average risk. Because if you just go with that panel and you ask yourself, what is the average standard deviation of these firms? It will be somewhere around 32%. And here you see 1/n is less than 32%. We could, for example, do inf op pandas data frame and just describe. So that is together with the 1/n portfolio, right? And just the standard deviation. The average firm had a standard deviation of 33%. That's what I exactly meant in that graph here, somewhere here. 33 is the average. Yeah? The median is also at 33. So you really see at 33, there's a dividing line. 50% of the firms are to the left, are to the right. And the lowest volatility is 22.19, and that is exactly the market volatility, the 1/n. Yeah, that's diversification benefit that you get. Because the average firm has a mean of 5% in the past. And for the market, we just also see it earned 5%. So you just really see you do not give up average returns if you build a portfolio, but you lose volatility. And that's what you want, unless you feel pleasure from just speculating, which people don't do. Right? If there are high stakes in the game, then people are either risk neutral or risk averse. And as soon as they are risk averse, they don't like to take volatility risks, volatility fluctuations without getting compensation. So therefore, building portfolios is a good thing. Just, I think what's the good thing is get rid of unnecessary volatility. And that is what diversification is. You just get rid of that unnecessary vol. All right, stay tuned and we do something else in the upcoming video.